Well, David Macdonald is the Chief Economist with the Canadian Centre for Policy Alternatives, and Matthew Stewart is the Director of Economics for the Conference Board of Canada. Good to see you both. Thanks for being here. And the idea is that here we are 24 hours after the budget, see if we can, we've had a time to sort of dig into what's in this budget and try to help people understand some of the key measures. And one of them that I wanted you gentlemen here to talk about is this new incentive for first-time home buyers. And David, I guess let me start with you. Walk us through it, if you know now 24 hours later, how it works. And I know there's still some questions on it, but tell us what the objective is, how it's supposed to work.
Well, the idea is to provide new homeowners with some additional loan capacity, in essence, that's provided instead of from a bank or from the house of the bank of mom and dad, being provided directly by CMHC. And so the details are actually quite unclear at this point. We know the thresholds: you have to make under 120,000. They'll support up to a house value of just under $500,000. Right. But in terms of what's the interest rate on this loan? Is it in effect a 0% interest loan?
Is it free money?
Is it free money? You know, or is it an actual equity stake? So if the house price goes, your house value goes up 20%, you owe 20% more, and if your house price falls, you owe 20% less, say, back to CMHC when you sell your house. Those details aren't available for the summer, even though the program is going to be launched in September. Right.
Matthew, as you look at it, what do you share the same concerns?
Yeah, absolutely. They weren't very clear on the details on whether it's an interest-free loan or whether you have to pay back some sort of equity. But I do think it'll have, an impact on increasing prices in the housing market.
You think it might backfire?
Yeah, it may end up that we have higher prices, and it just results in people paying more for houses that are already at a peak levels.
When I talked to the finance minister about this last night and presented this thesis to him that this might actually drive up housing prices, his suggestion was, look, we're looking at 100,000 people over the next 3 years, and this is across the country, so it's not likely to have. He didn't think, they looked at it very carefully, said the effect of driving up prices because it wouldn't be that much of a change in the marketplace. You think he's right, wrong?
Well, it'll probably have. I mean, just like real estate is a very local market, so how many places can you buy in Toronto for $500,000, right? I mean, you can barely get a parking spot in Toronto for $500,000. And so for smaller markets, it's likely that this might have a higher take-up, and there is where you might see that price pressure. It might not be distributed evenly across the country. But in essence, what this is, it is another form of debt. And so we're taking house prices at almost peak levels in many markets. Mm-hmm. We're saying to millennials, you can't quite make it. Let's push you over the line just enough for you to incur this substantial new amount of mortgage debt and a little bit of extra debt from CMHC so that you're at record high debt levels.
Is that still true, though? And I guess that's still the devil in the details question. If this is potentially, and I'm not sure, would it ever be free money? I mean, it's hard to imagine that if you get 40,000 from CMHC, that when you sell your house 9 years later and it's made, it's accrued in value, that you pay back 40,000. That's it. I mean, that's unlikely, isn't it?
I think so. The key wording is it's an equity stake in the housing, right, and in your house. And when we spoke to the experts at CMHC, this is still under discussion. So we have yet to see how much you're actually going to have to pay back.
Okay, but you pay back something. But I mean, if it's not that significant, when you talk about some of the risks of being, allowing you to take on some extra debt, maybe to get into the housing market, but could it be worth it? Could it be worth it if you're paying back at a small equity interest rate, I guess, by the end of when you resell this house? Is it a good value proposition?
Well, this is one of the problems, is that we've really fetishized home ownership as the entry point for the middle class. And so we're saying to millennials, here's a bunch of programs just to get you over that line, to indebt you at the highest levels that we've ever seen in Canadian history on the mortgage side. It's not necessarily a good idea. A better idea would be to meet millennials where they are, which is not in the housing market, it's in the rental market, the middle class rental market. Which
well,
is
they did talk about that in the budget as well.
Well, I know they didn't. That's what I mean. And so that's presently being operated through, in essence, condo construction as opposed to purpose-built rentals, purpose-built apartment buildings to fill that middle-class need. This is a shortcut to a long-term problem, which is we need to wait for 10 or 20 years for incomes and inflation to eat away at house price values so that they become affordable again.
Can that happen? I mean, house value prices, am I wrong in suggesting they seem to climb a lot more quickly than wages, or so can you ever catch up?
I think some people are going to be very happy with this measure. It is going to help, a certain demographic get into the housing market. They may end up being quite happy with the support that they're getting to get into the housing market. But it does fly in the exact opposite direction of all the other policy work that we're doing to ease household debt, and he's take some of the steam out of the housing
How do you
market.
mean? Give me an example. What are we doing that contradicts this policy?
Well, we've released all the new stress testing to make it more difficult for people to qualify for mortgages. And the reason we're doing this is because we're concerned about the amount of household debt that a certain number of households have taken on. And so this is the exact opposite. We're encouraging people that might not have been able to afford a house before to get into that market. And really, it's in the opposite direction of everything we've been doing recently.
Okay, I mean, who's likely to take advantage of the program? For people watching, who are the people that should give this a second look and say, maybe this does work for me? We've already raised some of the red flags. Or should you just turn your back on this and say, you know what, this is not the way I want to get into the housing market, this is risky?
Well, I mean, I think if you did not qualify and this is what's going to push you over the edge, I think you should seriously consider whether what you're buying is the right decision. I mean, we are at inflated house price values. There's no harm right now in renting for another year or two to see whether house prices go up or down or sideways in the market that you're in. We actually are seeing house price declines. I mean, the stress testing, as you mentioned, is doing its job. It's constraining average national house prices. So we're not seeing the same kind of 10 percentage points a year increase. So I mean, I'd be very concerned if this was the decision-making point. I mean, that's something to speak to folks to say, maybe you should actually be renting for a while longer.
What do you think, Matthew?
I think a lot of people should take a look at this, but the key is to make sure that you're not overstretching yourself. We know interest rates are going up. We know that the economy, as it moves towards full capacity, we're going to have to raise rates. So you've got to keep that in mind. You don't want to overstretch yourself on the interest rates.
A couple of quick things to finish on. Let's talk of the other measure that was in this was the allowing first-time home buyers to take an extra $10,000 from $25,000 to $35,000 out of their RRSP savings if they've got those, and put that towards a down payment on a first home. Is that going to make a big difference? The fact that there's now an extra $10,000 available, if you happen to have it, if you're a first-time home buyer, if you happen to have that, is the $10,000 going to say, okay, this changes my decision to buy or not buy?
There's got to be a pretty limited pool of people at 35 that has $45,000 in their RRSP. And can use it as opposed to the $35,000, which was the previous limit. So I don't know what the uptake of this program would be. But again, this is another way that we're encouraging young homeowners to take on different types of debt, not the traditional kinds like mortgage, but different kinds like through CMHC or through their RRSP. They do have to pay this money back. I mean, it's not free money in that sense. It may be at a lower interest rate, which is obviously better than what you might get from the bank. But let's not fool ourselves into thinking that these aren't types of debt that have to be repaid.
Matthew?
I just don't think it's a big enough program to make much of a difference. I don't think there's enough Canadians with that kind of money at that stage to make that much of a difference.
Let's talk about this budget in the context of where we are in the economy, because there's always a contextual question and a setting around a budget. And just a general question, what we saw from Bill Morneau yesterday, not just housing, on the broader issue. And let me start with you, Matthew, because I know the conference board, you put out your spring outlook. Does anything in this budget change the outlook? And I guess give us a sense of what you're expecting in the year ahead and whether this budget makes a difference.
First, it doesn't make much of a difference. One of the things, this is where the budget failed, I think, is that one of the things that the biggest struggle in the economy right now is the lack of business investment and the lack of willingness among companies to invest in Canada. And this budget didn't address that. So that's still a major problem that's going to affect Canada's economic growth and our productivity going forward.
Which is going to, what's the next year look like?
Much lower growth.
Much lower growth, because we've started to see a decline already in the last 6 months or so, and that's going to continue? Yeah,
as consumers have a lot of debt right now, and so as the consumers are affecting the economy much less, we have to look towards businesses to invest in Canada. And we just released a survey of business leaders, and we asked them, are you willing to invest in Canada? And just 30% thought it was a good time to invest right now in Canada. So that's what we have to see improve if we're going to see a stronger economic growth going forward.
David, what's your sense of the overall impact of this budget?
Well, it would be interesting to see how the $2.2 billion that's transferred to cities will be used, because in essence they're cutting the check in the next 9 days.
Yeah, this is the
fiscal year
emergency, but it's a top up of the gas tax fund.
And it's a fair amount of money going out to the cities, which could push economic growth this summer if the cities are able to accept that money rapidly and turn it back over and spend it if they've got deferred maintenance they weren't otherwise going to do. And so that will be interesting. I mean, the other interesting piece in the budget was that there were big surprises on the revenue side. Personal income taxes came in much higher than they were expected despite soft growth in the fourth quarter. And so unemployment rate remains relatively, remains almost at historic lows, even though we're seeing some softness in GDP. So it will be interesting to see going forward whether the softness in GDP in the fourth quarter is going to start to bleed back into the labor market, or whether the labor market will remain strong. And what will happen on the wages front, right?
Explain to the non-economist in the group, so that's me, when you have good numbers like almost record low unemployment, you have this job growth, and how does that connect to companies saying it's not a good time to, clearly if we're starting to employ more and more people and hire more and more people, you'd think that it's a good time to invest.
Yeah, and that's usually the link. Usually when the economy is doing well and we're running at full capacity, that's when companies invest. And that's what the Bank of Canada has been calling for quite a while. There's a shift towards business investment away from the consumer-driven economy. But we haven't seen that. And the reason
Why are they so reluctant?
It's really around our competitiveness. A lot of the companies that we talk to are looking at their operations in the US and they're looking at Canada and they're saying, okay, where should we invest? And that competitiveness is really what's driving or keeping investment away from Canada.
Do you share that concern? A number of economists have said what this budget failed to do is increase Canada's competitiveness.
Well, it is certainly true that we have seen a real failure in business investment in Canada, and it can be a key driver of growth. One of the downsides is that despite the fact that we've reduced corporate income tax rates several times over the last decade, with another decrease in terms of amortization periods that came in the fall, we're still not seeing this business investment. So, I mean, we keep cutting the taxes side in the hopes that will drive businesses to invest, and it just isn't panning out in Canada. And so I think what would be more interesting is to see if government expenditures are the way to drive growth, to push that unemployment rate down further, but in particular to drive wages up. This is one of the things that we're really missing in Canada is we are seeing wages increase, but they're certainly not at historic high wage gains. They're more average wage gains, which you wouldn't expect to see with such a tight labor market.
All right, gentlemen, thank you both for your time today. Appreciate it.
Thank you.